Hello, everyone. Imagine this. What if you could build a stress-free, diversified investment portfolio with just 4 ETFs? A portfolio that lets you grow your wealth, sleep peacefully at night, and still have time to actually live your life? Sounds too good to be true? Well, stick around because today I'm breaking down a powerful yet shockingly simple 4 ETF portfolio using VTI, Vermont, SCHH, and VNQ. And trust me, this isn't your average ETF video. I've got some surprising insights, a bonus tip at the end that could supercharge your returns, and a twist most investors overlook. So stay with me until the very end. You won't want to miss this. Hello, viewers. If you're enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First things first, why just 4 ETFs? In a world where investors are constantly chasing the next hot stock, real wealth often comes from simplicity, discipline, and consistency. The truth is, most investors underperform the market by overcomplicating things. A simple, low-cost ETF portfolio has historically outperformed most active traders. By using just 4 carefully selected ETFs, you can diversify, globally gain exposure to real estate, minimize risk, while maximizing long-term growth. And we're going to break down exactly how this works. Let's start with the backbone of this portfolio, VTI, the Vanguard Total Stock Market ETF. VTI gives you exposure to over 3,500 U.S. companies, small caps, mid caps, large caps, all in one simple fund. It has a rock-bottom expense ratio of just 0.03%. Historically, the U.S. stock market has delivered average annual returns of around 10%. With VTI, you're not betting on one company or one sector. You're betting on the continued innovation, resilience, and productivity of the entire U.S. economy. Fun fact, if you had invested $10,000 in the total U.S. market 40 years ago, you'd be sitting on over $1.2 million today. That's the power of broad market exposure. Next up is VT, the Vanguard Total World Stock ETF. VT gives you exposure to over 9,000 stocks across the globe. U.S., Europe, Asia, emerging markets, it's all here in one fund. With VT, you're not just investing in America's future, but in the growth of humanity itself. And here's something most investors forget. International markets tend to outperform at different times. Some of the fastest-growing economies today are in places like India, Brazil, and Southeast Asia. VT ensures you're not putting all your eggs in one basket. Shocking stat. Over 4% of the world's market capitalization lies outside the U.S., Ignoring global stocks means missing nearly half the opportunity. Now let's bring in SCHH, the Schwab US RIT ETF. Real estate investment trusts, REITs, give you exposure to income-generating properties, office buildings, shopping centers, healthcare facilities, and more, which focuses on US REITs with solid performance and high dividends. Current yield? Roughly 3–4%, which is excellent in today's markets. Adding real estate to your portfolio helps you protect against inflation, earn steady income. Add diversification beyond just stocks, surprising insight. REITs have historically outperformed the S&P 500 in multiple decades, yet most portfolios lack this key asset class. Finally, we have VNQ, the Vanguard Real Estate ETF. Like SCHH, VNQ focuses on REITs but with a broader mix, including global exposure. Real estate tends to behave differently from stocks, providing a smoother ride during market turbulence. VNQ currently offers both income and growth potential. Combining SCHH and VNQ gives you a comprehensive exposure to both domestic and international real estate. Here's the beauty. When stocks zig, real estate often zags. REITs can help reduce volatility and provide cash flow even in downturns. Now you might be wondering, how should I allocate these 4 ETFs? Here's a simple example allocation. VTI, 40% U.S. stocks, VT 30% global stocks, CH 15% U.S. real estate, VNQ 15% global real estate. This mix gives you growth from both U.S. and international stocks, income, and stability from real estate, protection from inflation, all at an incredibly low cost. Of course, you can tweak this based on your risk tolerance. More conservative, increase real estate. More aggressive? Tilt toward VTI and VT. And remember, consistency beats perfection. Okay, if you've stuck with me this far, here's the bonus tip I promised. consider adding a covered call ETF like QYLD or JEPI for income. While our 4 ETF portfolio focuses on growth and stability, adding just a small slice of income-focused ETFs can boost your passive cash flow, protect against downside risks, offer monthly dividends, but be cautious. These should never replace your core holdings. Think of them as the cherry on top. To wrap it all up, with VTI, Vermont, SCHH, and VNQ, you can build a portfolio that's simple, diversified, and built for the long haul. You don't need to time the market or pick the next big stock. You just need to start, stay consistent, and let time do the heavy lifting. If you found this video helpful, do me a huge favor. Hit that like button. It really helps the channel. Subscribe for more content on investing, ETFs, and building wealth. And share this video with someone who needs to simplify their investment strategy. Thank you so much for watching, and I'll see you in the next one.